Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Meera Duggal.
I'm Harsha Subramaniam. The headlines at this hour. Markets pick up steam. The Nifty trades above 10,650 as IT stocks rise. Broader markets outperform. Sebi bars Pricewaterhouse entities from issuing audit certificates for 2 years for its role in the Satyam scam. Commercial vehicle sales jump more than 50% in December, while two-wheeler sales rise 40%. Passenger vehicle makers lag. Earnings season kicks off with two Nifty companies, TCS and IndusInd Bank, slated to report third quarter numbers later today.
All right, all those stories coming up over the next hour. But as always, let's start with dipping into the markets. Neeraj Shah is here with us. Neeraj.
Well, I don't know if the market is believing that there will be some 3-4% revenue growth in IT companies, because it's just going berserk on IT names. Just look at the last 30 minutes, 40 minutes of the Nifty IT chart, and you will see what I'm talking about. So today's chart will essentially show that. Look at the strength in Nifty IT, 0.75%. And then I've just dated it back to the last 3 months. There has been a 17% uptick in Nifty IT since October. So it's a great last 3 months, great last 3 days for IT. And that's really spurring some strength on the Nifty 50 as well. So Tech Mahindra, Infosys are amongst the names which are doing well today. Not so much as Wipro, but the others are certainly doing well. Mid-cap IT is a bit quiet. It's essentially large-cap IT which is doing what it is doing. That aside, at the broader end of the spectrum, we're seeing some gains for select distillery companies. I mean, Som was just one, but I think a couple of others are not doing too bad. There is some strength in those pellet companies like Godavari Power and Ispat and some of the others. So there the strength continues, and there's fundamental reason as well. Remember, we've seen yesterday Sajjad Jindal tweet at length about the iron ore ban in Orissa and the impact that it could have on the steel companies. So while that remains, the beneficiaries like Godavari Power and Ispat and Prakash Industries are fairly interesting plays as well to watch out for. At least that's what market men seem to be believing. So that's one more basket to watch. And last but not the least, I don't know if it's got to do with the Navi Mumbai airport or an industrial city around it, but everything connected to that pocket. So GVK Power, Jacop, Reliance Industrial Infra, Skill Infra, all of them very, very active stocks. 3, 4, 5%. In Jacob's case, of course, 7%. But those are the quantum gains that are the order of the day today for almost all of those players.
Neeraj, thanks for that. Let's talk about earnings. Two Nifty companies, as we said, IndusInd Bank and TCS are slated to report numbers today. Let's start with IndusInd. That will be out anytime now. Shraddha is standing by to what we need to watch out for and broad expectations from lenders in this quarter. Shraddha.
Well, if we just talk about the banking sector overall, Harsha, it's softer revenue momentum, elevated credit costs and bond losses, which are likely to be dominant theme for earnings in this quarter. More so on the back of the way GSEC yields have actually hardened. So if you look at how the 10-year yield on benchmark bonds have moved in the October to December quarter, they've risen by 67 basis points. If you compare it with the same quarter last year, they had actually fallen by 30 basis points, and hence banks will have to take a MTM loss on their investment and trading portfolios, which will impact earnings negatively. PSU banks, of course, likely to get impacted a lot more. PNB, Union Bank of India and Vijaya Bank are likely to take the larger hits. Talking about the more important asset quality aspect, incremental stress creation, that's expected to be softer this quarter as well, but recoveries and upgrades are expected to be muted on account of slower resolutions. When we talk about credit costs, again, expected to remain elevated on account of two factors. Firstly, the fact that banks will have to make provisioning for the second list of stressed accounts, and they might also have to provide for a higher NPL cover on account of the kind of indications that we've seen from the bids, which have suggested a haircut of up to 75%. So credit costs will remain higher. Additionally, in this quarter, banks will have to make provisions for exposure to Reliance Communications, and the impact of divergence from RBI's audit again is going to be the key monitorable. In terms of the outperformers, once again, retail-oriented banks like HDFC Bank, IndusInd Bank and Yes Bank are likely to post that 20% sort of growth numbers. But for some PSU banks in this quarter, the net profit growth numbers might look optically higher, but again, that will be only on account of the very, very low base that we had seen in the last quarter.
Shraddha, IndusInd in particular should be out any time now. What are the analysts pricing in?
Again, given that it's IndusInd Bank, we don't really see too many surprises from the bank. They have consistently managed to deliver on the earnings front, so that's expected in this quarter as well. In terms of the key numbers, net interest income and net profit both are seen growing by about 23%. The net profit number that the street is working with is 927 crores. Margins expected to be stable at 4%. Loan growth expected to come in at about 24 to 25%. You should see faster growth on the corporate finance book as compared to the consumer lending book. Asset quality again expected to remain stable. Gross NP expected around that 1.1% number, and divergence, if any, from the RBI audit will be disclosed. But again, this is not a very large concern as far as IndusInd Bank is concerned. With respect to its exposures to the stressed accounts, they've completely provided for the first list in the June quarter itself, and in the second quarter they had provided for about 36 crores or so for the second list accounts. Broadly, amongst the key things that the street will be watching out for will definitely be any commentary with respect to the progress on the merger with Bharat Financial, which happened after they announced their second quarter numbers. Also, commentary or continued market share gains in vehicle financing is something that the markets will track, given that CV sales have really picked up in the quarter. RBI audit outcome, traction in CASA, and also the traction in non-vehicle consumer lending portfolio is something that they'll be watching as well, Ira.
Shraddha, thank you for that. You can catch the management. Ramesh Sobti, Managing Director and CEO at IndusInd Bank, will be addressing the media a little later in the hour. We'll try and get you live coverage of that too. But the other focus of earnings today is IT. Seasonally weak quarter for IT companies. Agam Vakil is standing by to tell us what we should be looking for in the IT space. TCS today, Infosys tomorrow. Agam, over to you.
Well, Harsha, this quarter is going to be more about what the management has to say about the outlook and not so much about the performance. But, speaking of the performance, we're expecting not a very great quarter, given the fact that we have furloughs. So the element of seasonality comes into play here. In terms of expectations, we're expecting about 1 to 2% growth for the top IT companies in the Nifty, and margins are expected to remain largely in line with what we've seen in the previous couple of quarters. The only exception in this case will be that we are going to see very little impact when it comes to cross-currency headwinds or tailwinds for that matter. Guidances are expected to remain the same, despite the fact that we have seen Accenture come in and project a gradual recovery in BFS vertical as well as the US markets. But in terms of what we're going to watch out for, of course, Salil Parekh and his plans for Infosys. He's been in the job for just about less than a couple of weeks now. TCS and the kind of trends that they are seeing while experimenting with their clients, and of course the changing client spending trends along with their requirements as well. So see, those are some of those cues that I'll be watching out for when it comes to earnings from these IT companies.
TCS in particular, Agam, what's the expectation there?
Well, Ira, like I said, very, very quiet quarter. We're expecting about 1.1% growth in dollar revenues sequentially. Margins expected to remain largely flat around 25.3%. And profits expected to grow around 1.4%. Again, what I'm keeping an eye on is the commentary from the management, which has all suggested that they are working with their clients and experimenting and trying to identify successful business models. This is going to take some time, but as far as the visibility of the BFS vertical is concerned, that is something I'm going to keep an eye on. And of course, let's not forget, the impact that the warning, or should I say, the indication that the Accenture earnings have thrown. That is something that I'll be also watching out for, and what kind of impact it has on TCS.
All right, Agam, thanks so much for that. Those are the two big earnings. We'll try and get you an analyst view a little bit later as well. But the big story that broke late yesterday night, 9 years after the Satyam scam came to light, Sebi has found the company's audit firm Pricewaterhouse guilty of overlooking the anomalies. The regulator bars PW network firms from issuing a certificate of audit for listed firms for the next 2 years. This does not include the current financial year, though. Pricewaterhouse partners Srinivas Taluri and S. Gopalakrishnan have been barred for 3 years each.
In addition to that, the two partners in Pricewaterhouse Bangalore have been ordered to disgorge wrongful gains amounting to 27 crore. Earlier today, Menaka caught up with the former president of ICAI, Amarjit Chopra, to understand the implications. Listen to that slice of that conversation.
The most unprecedented move that we have had in this country, But so far as the viewpoint of PwC is concerned, let me say that there is no doubt that ICI has the jurisdiction so far as the discipline proceedings are concerned. But in the entire thing, one thing was coming to light that the institute didn't have powers to debar any of the firms because as per the CA Act even today, we can only debar a member from practicing or undertaking an trust function or doing some other professional work. But in 2010-11, we had actually requested the central government to undertake a change in the CA Act, whereby the ICI also has the authority to debar the firms wherever we feel that there are huge kind of frauds like this or the other partners were in knowledge of certain things. But so far the government has not acted on that. I am not getting into that.
Mr. Chopra, would you say that SEBI's action against the entire PW network in India is justified as opposed to just curtailing the action to...
I will say that they are all the regulators for the listed entities. And if at all they feel that public has been cheated, they could have gone ahead. One may say that ICI should be the only regulator, but if there are certain compulsions by way of which certain action cannot be taken against the firm, probably some other regulator steps in.
No, I get it. I understand that you're saying that, yes, SEBI does have jurisdiction. I mean, I don't think even I would argue that it doesn't have jurisdiction given that this was a listed company. I'm just wondering whether you agree with the fact that SEBI has taken action against the entire network of PW firms in India and not just the two firms that were connected to the audit.
There is no point, Manka, that we keep on acting against a particular entity only and not against the other network firms, because if they can keep on taking the attest function of the other major entities, there is no point in acting against only one particular entity, because we have PwC Bangalore, we have PwC Delhi, we have PwC Mumbai, we have PwC Chennai. I think somewhere or the other, this is one thing which needed to be plugged. And today, probably someone would start realizing, and if you look at companies like 2013, now, even when the Section 144 comes into play, where it talks of the certain services which cannot be taken up by an auditor, there it talks of all directly, indirectly, or by any other related entities. Let's be very clear about it. So the government in the Companies Act 2013 has already undertaken this particular check. So if SEBI has gone ahead and said that if one part, after all, you are sharing profits amongst yourselves, you cannot be immune, you cannot be given immunity against certain action of the certain other partners. So to my mind, there is nothing wrong, but what really baffles me is that you are saying only in respect of the listed entities. Probably SEBI has only jurisdiction.
I would imagine SEBI has jurisdiction only on listed entities. Everything else, the Ministry of Corporate Affairs or the ROC has to take action.
But ROC may not be able to take action because so far as Mr. Taluri and Mr. Gopalakrishnan are concerned, the institute had debarred them for the lifetime.
Right.
Already, their name has already been removed for the lifetime because that's the only penalty that the institute could have been imposed.
I think only one of them has been debarred, sir. The second one, I think proceedings are still going on, if I read the SEBI order correctly.
I can only tell you that Mr. Gopalakrishnan's name was removed for the lifetime, if I'm not mistaken. And in the other cases, they have been moving the courts. Tribunal has already upheld the ICI's order, basically. But then these things continue.
So let me put one final question to you, Mr. Chopra. I think that, at all points, on all the charges that I've detailed that were laid out in the SEBI order, many of the arguments that PwC has put up in its defense is that, if the company or its officials want to scam an auditor and go to such great lengths of creating, fake letterheads and fake bank statements and all of that, it's very difficult for an auditor to keep verifying. And I'm putting this argument very, very simply. PW has also in its statement late last night said that it hopes to seek a stay and obtain a stay on this order even before the order can go into operation, though it is operative immediately. What do you make of how much success PW could potentially have in defending the point that, look, how many verifications can we do? Should we be verifying all of this constantly? How much independent verification is required?
If you really ask me, auditor today is in a very, very precarious kind of a position because the promoters, the bankers, the other people can also be in leave, very frankly. But here, of course, I don't have in my hand the original documents. But if SA 505, that is with regard to the external confirmations, has not been complied with, and proper verifications have not been taken by the auditor can definitely be held guilty. And I think the entire flow of the order probably seems to be that PwC auditors were negligent in obtaining direct confirmation from the bankers, etc.
That's right.
But so far as these fake documents are concerned, with regard to the invoices, etc., I think it's a major challenge that the audit profession faces today. After all, even with regard to title deeds in respect of certain properties few years back, the banks were facing the same problem. When this colored Xerox came in, it was difficult to make out which is the original and which is the duplicate.
Yes, sir.
But we have to live with these challenges as auditing profession, basically. And I think the institute, the other regulators need to come together and really to give something by way of which the auditor also feel protected. Because the way the frauds are going on by the companies, I think the auditors are in a very, very difficult kind of situation. And I have some sympathies with the PwC on this particular matter. But then, at the same time, if certain auditing standards have not been complied with, which should have been complied with, and it is a major fraud, basically, right. In that case, I think the law has to take its own course. Whether they get a stay or not, I'm not really bothered about it because I think in these kind of cases, the courts jump to give the stay. Because I know how much time I lost as a president only in getting the stay vacated so that we could proceed against the PwC in that particular year.
I remember that, sir.
Yeah.
All right, that's the former president of the ICI talking about SEBI's action against Pricewaterhouse firms and what it means. But let's move on. Reliance Jio is taking the telecom market by storm truly in more ways than one. The new entrant is likely to report its first ever quarterly profit in the third quarter. Saket Sundari of Bloomberg News is here with more. What do we know?
Well, this is only the second quarter of Reliance Jio reporting its earnings separately, and in all likelihood, they are going to report a net profit already. I mean, it's way ahead of expectations. Some analysts have already talked about it, and they have pointed that there is a possibility. But we know now that Reliance Jio will report net income, positive net income for the first time, most likely in October, December, or maybe slightly later, Jan-March, but this fiscal they're going to do it.
What has led to the sort of the improvement in the operational performance?
There are two things working here. They have had a really phenomenal subscriber addition, and that has led to good growth in revenues. Costs are still low for them, and the best thing that worked for them was the cut in interconnect charges by the government. That will take away more than 1,000 crores out of operating costs in a quarter, given the numbers that we had in the first quarter. So that itself will entirely flow into the bottom line.
Saket, their latest scheme, which they announced a few days back, had led to some people saying that they are primarily interested in market share and they will hold on to that. But it looks like they're managing to do that along with fairly quick profitability.
Yeah, that's how it is, and it's really surprising given that the competition in the market has really heated up. Airtel and Vodafone and other big competitors are already combating Reliance with their own tariff cuts and everything. Reliance has so far maintained the low tariffs that it had given while launching the services, and it's just about a year and a half that they are in business right now, which is a really quick time for a company to come out with really good numbers in terms of bottom line.
Okay, thank you so much for that. That's Reliance Jio for you. It's likely to turn a profit as early as the second or as the third quarter, says Saket. This is something some analysts on the street were anticipating. This is just the second quarter since Reliance Jio have been reporting numbers. Okay, let's move on now. Automakers had a blast in December, clocking double-digit sales across the board. Commercial vehicles, however, have led the charge with over 50% growth. But heading into the new year, what's on top of the industry's mind? Let's listen into the Director General Vishnu Mathur of SIAM on what he had to say.
I think if you look at the projections that we did in April, for passenger vehicles we said 7 to 9, now we are talking about 9. So it's not really an upward revision. For commercial vehicles, we had really erred. I think we talked about 4 to 6%. We have done 13%. Nobody is unhappy. We are all happy because we think that the commercial vehicles took the maximum time to recover from demonetization. Demonetization happened in 16 November.
Right.
And 17 November, we have done well. In fact, the previous month in October, we did very low growth. From November and December, we have really grown 50% plus, and that has resulted in taking the commercial vehicle out of the problems. And I think we are all happy. If you look at the two-wheelers, three-wheelers, all the categories, we have done more or less what we had said. There is not really much of a thing, but we are going to end at the higher end of the projection.
So, sir, would you say that at the beginning of the fiscal year, projections were more modest, considering you realized that the country was still reeling under demonetization then, and GST was just 3 months away at that time?
Yeah, I won't say our projections were modest. In commercial vehicles, we had not been able to anticipate this kind of recovery. But in all other categories, we have done fairly good projection.
Right, sir. We're at the end of this fiscal, and my next question to you would be about SIAM's and the auto industry's expectations from the budget. Could you give us, say, 2-3 key takeaways, key expectations that you have from the budget?
So in budget, first of all, every year in budget we discuss about the indirect tax, the excise duty, etc., etc. But this time, because GST Council is continuously sitting and they are addressing the indirect tax issue, that has been out of the budget preparation exercise. So we are left with only the direct tax and the import duty. We have talked about both direct tax and import duty, not a very significant recommendations, but we have talked about that please do not reduce the import duty on CBUs, the complete built unit. Please keep it at the same level for passenger vehicles, two-wheelers and others. For commercial vehicles, we have said that in fact the duty should be increased from current 20% to 40%, because actual duty is 40%, but through an exemption route, the government has kept the duty at 20%. We are saying that please go to the 40% what was originally announced. And we have, in fact, in WTO also our bound rate is 40%. So we can easily go up to 40% and keep it at 40%.
All right, we'll slip into a quick break. Coming up on the other side, UIDAI has added new layers of security for Aadhaar. We'll tell you how it works.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
More than just business news, we're news for business people.
Back on Parliaments, the headlines at this hour. Quiet day of trade on Dalal Street. The key indices trade near the flat line. Mid-caps outperform with 0.5% gain for the index. Reliance Jio is likely to report its first quarterly profit in the third quarter. That's a Bloomberg exclusive. Earnings season kicks off today. IndusInd Bank may report 20% plus profit and NII growth. TCS is expected to deliver 1% dollar revenue growth. Oil trades around its highest levels in 3 years as US supplies shrink. Goldman Sachs commodity chief says OPEC will try to talk prices down if oil tops $70. UIDAI adds new layers of securities for Aadhaar, introduces virtual ID and limited KYC features to strengthen privacy. All right, let's talk about the big focus today on earnings. TCS kicks off IT sector earnings today. What's expected? What's the street anticipating? Sandip Agarwal, senior analyst at Edelweiss Financial Services, joins us. Sandip, thank you so much for joining in. What are you expecting from the IT guys this time around, particularly the top two, TCS and Infosys, on dollar revenue growth?
So see, we are expecting around 70 basis point quarter-on-quarter growth for TCS, which is lower than street estimate by 30-40 basis point, and a flat EBIT and a margin decline of 30 basis point. In my view, the winters have been pretty harsh, and so would have impacted manufacturing. The furloughs could have been higher. So that is one concern because of which we have taken lower margin. Also, there is not much favorable movement from rupee. So because of that, we have taken a shrink in margin. Otherwise, generally in this quarters, the margins improve. So actually, we could have some positive surprise on the margins, maybe if the manufacturing in reality doesn't turn out to be as harsh as we are expecting. But I think the more important thing in this quarter, being a seasonally weak quarter, would be on the commentary, because most of the corporates go and meet clients in December and they try to get a feeling on what the clients are saying on the current new year budget. So that will be a very, very important thing to look at. In my view, TCS will give a good update on that, because they travel extensively and give an update generally in this quarter results what clients are saying. So if there is a optimism on the BFSI spend, it will be a big positive, because if you see in Indian IT industry broadly 35 to 40% revenue comes from BFSI. So if the BFSI starts firing, then the scenario could be very, very positive. We have been awaiting BFSI spend for now last 3-4 quarters and hopeful that BFSI commentary would be positive. Second thing which is very important is the deal sizes in the digital. So if you see last quarter, Accenture and TCS kind of gave a hint that deal sizes are becoming slightly bigger in the digital space. Even Accenture said that it is industrialization of digitization has started. So that is a very big positive statement, considering that if the deal sizes become big and they start coming to these players of scale like Infi, TCS, HCL and Accenture all, then it will definitely move up the growth rates. So in my view, these two things are key in the quarter, and rest of the things I think are just quarterly numbers which are more or less known. So I would be very optimistically looking on to these two commentaries, one on the BFSI and the other on the digital deals.
Okay, Sandip, you alluded to what Accenture has done. Nearly 50% of the revenues for Accenture today comes from social mobility, cloud implementation work, analytics and so on. How do you think the two big guys, TCS and Infosys, have performed on all these areas which really should be delivering a large chunk of revenues? Is that at least on track from a yearly perspective?
Yeah, I think yes, you are right. So, but the good part is that they have also come to 18 to 20% range broadly, and in my view, we are much better positioned than last year when the percentages was low, because the growth rates have not really tempered. So basically, what we are saying is that if 20% of the revenue, let's say, continues to grow at 20-25%, then 4 to 5% of the growth can come alone from the digital side. So that will be a big positive. So I am pretty confident that both the companies have good capabilities. TCS has done a lot of work in digital in past as well. So I think they are very much on track, and in fact slightly better than expectation on the digital side at least. So
you don't belong to the camp that believes that legacy IT work is coming under pressure both from a volume and pricing standpoint?
See, that is the fact. Means it is coming under pressure. That is true. But the question here is that the pressure there is, let's say, 1.5% annually, and if the digital is firing at 20-25%, then it more than compensates for that loss. So we are not saying that we are close to 20% or 15% growth, but what we are saying is that the bottom of the growth definitely is behind. 5-6% really is the bottom, and we don't see it going further down below that. So I look at it like from here the things will improve. That is the way I look at it.
What about Infosys? The company has a new CEO, a completely new board. And Salil Parekh comes with enormous amount of experience in managing some of digital transformations as well. What are you working with both from a numbers standpoint and strategically, what are you expecting?
See, we are expecting a 140 basis point quarter-on-quarter dollar revenue growth in Infosys, and we are again here also because of manufacturing furloughs predicting a margin dip of 40-50 basis point. But let me again clarify that manufacturing is something which is just again we guess because we don't know exactly how many days of work would have got impacted and holidays and all. So there could be a positive surprise in terms of margin, and Infosys, if you see, has the highest margin levers because of the very low fixed price projects which they are executing right now. So the scope for much more fixed price project going forward and automation is highest within the sector. So Infosys can definitely surprise much positively on the margin side. And the new CEO coming in definitely puts to rest all the kind of speculation and management instability questions. So from that perspective also it looks pretty good. The question is that how they guide in the sense that what tinkering they are doing to the guidance. In my view, they will not do any tinkering. They will stick with what they have said, and some kind of positive commentary or something on BFSI and again digital for the next year would be very, very positive for the stock. That is the way we look at it. But yes, management instability is largely behind in my view.
What about pricing, Sandip? We haven't heard anything from either TCS or Infosys in the last many quarters on how pricing is going to play out. Is that headed south, and is that inevitable?
See, in my view, there is a slight confusion on the pricing and realization part. So if you see the amount of effort which are required to execute, obviously that is going down very sharply. So on a project level, definitely there is a dip, and you have to compensate for that with new business. But I don't think the per hourly rates have changed at all. So that is not what I think so has happened. And we also met management some time back, and at least one of them said that we are not seeing any pricing pressure to call out for. So my sense is that efforts are falling, so the deal sizes are falling, and that is putting a lot of pressure to get more and more new business. And in spite of new business coming in very nicely from the digital side, it is not able to compensate because the old deals which were at $100, let's say, they are getting renegotiated at $60 for the project. So the project level sizes are going down.
Okay, just to push that point a little further, for the deal, if the deal sizes are going down, the real chunk of the money is in the large $100 million plus deal size, isn't it? Is there any visibility that you have on the deal pipelines for these companies? Again, none of these guys have bagged large orders anywhere in the last couple of quarters.
So see, if you see 2 years back, one large deal came in the whole sector, which was, I think, backed by Accenture, and after that we have not heard a multi-million, like $100 or $200, $300 million significant number of deals in the market. So there are 1 or 2 instances which keeps on happening every quarter. I think that may not be the true going forward as well, because you are under a technology transition phase where the way people are doing business, the way technology is changing. I don't think that 100, 200, 300 million deal will be very much relevant like in the past. So it will be more like smaller size deals, quick execution, and booking of revenues. So I think that is the change which is happening in the industry.
All right, Sandip, we leave it there. Thank you so much indeed for joining us. Sandip Agarwal from Edelweiss talking about the IT sector. Remember, TCS will be disclosing its numbers today, Infosys tomorrow. We'll keep a tab of that. IT stocks pretty much have been doing well. The Nifty IT index, as Neeraj was pointing out a little earlier, has been up as well.
All right, Bitcoin is sliding once again, dipping below the 14,000 mark. The latest blow seems to be coming in from South Korea, which is considering a potential shutdown of at least some of the exchanges. Bloomberg News' Eric Lam joins us with the latest details. Eric, what have you picked up? What is the development that's pushing Bitcoin down this morning?
Yeah, in South Korea, it's kind of a continuation on a theme we've been seeing from South Korean government over the last few months. Is the Justice Ministry was speaking to reporters today saying that they're preparing a bill that would potentially shut down cryptocurrency trading on exchanges in South Korea. This has been kind of an ongoing concern in the South Korean government. The South Korean Prime Minister late last year warned that it could corrupt the nation's youth, and South Korea's become kind of a ground zero for Bitcoin trading or cryptocurrency trading worldwide. South Korea and Japan have become kind of two of the largest, most popular places for trading cryptocurrencies. So for industry investors, this was not necessarily a surprising move, but it was still a negative one. We're seeing Bitcoin dropping, some of its rivals, Ripple, Ethereum, they're also dropping as well. So definitely some money is getting taken off the table.
Eric, you're right. You know, South Korea has been one of the sort of the epicenters of the speculative frenzy that we've seen in Bitcoin. What's the government sort of worried about that they have to hold them back?
Well, I think that for the government, they're worried that if it does kind of blow up in their faces, that they'd be left with holding the bag, that investors in South Korea are going to turn around and blame the government for not keeping them from doing something that they shouldn't have been doing in the first place. So I think that's definitely a motivation. I think they're also looking a little bit at, seeing there were similar kinds of rhetoric coming from China last year as well, and they implemented their own ban on or talked about implementing their own ban on cryptocurrency trading. They outlawed ICOs or initial coin offerings in China. And China now is also talking about cracking down on Bitcoin mining companies, Bitcoin miners. So I think South Korea is following along on kind of a widespread global theme of more regulation and more scrutiny from regulators around the world. So it's kind of continuing on in that theme.
Eric, here in India, one of our local digital publications, The Kennedy, reported that as the Indian authorities have tried to increase scrutiny on some of these exchanges, these Bitcoin exchanges, a lot of transactions are moving to OTC platforms. I'm curious to know whether similar trends have been noticed otherwise and across other countries as well. As you clamp down on the exchanges or increase scrutiny on the exchanges, the OTC platforms is where the action could move.
Yeah, that's entirely possible. One of my colleagues spoke to someone who said something similar. Same kind of behavior happened in China when China started cracking down on trading in that country. A lot of the movements went to over-the-counter or kind of those alternative places to trade, and it's entirely possible we'll see something similar happen with South Korea. I think overall for investors this year, you'll be seeing kind of investors going basically where the money is in the path of least resistance. As more countries, if we do see more countries cracking down on cryptocurrency exchanges, cryptocurrency trading, I think we're just going to go see that money move to countries where there's less resistance until they don't have anywhere to go to. But, I think we're still a long way off there because as we've seen over the past year, central banks and regulators are taking a very deliberate path to making decisions on this. Nobody's rushing in and making rush judgments.
Eric, we leave it there. Thank you so much, Sandip, for joining us. Eric Lam from Bloomberg News in Hong Kong, talking about what South Korea is doing as far as Bitcoin is concerned. Greater scrutiny. Of course, this has got governments and central banks across the world a bit worried. Shale revolution is now offsetting force to the strongest economic growth witnessed since 2004, says the global head of commodities at Goldman Sachs, Jeff Curry. In a conversation with Bloomberg, he said that a further rise in oil prices will prompt central banks to respond to inflationary pressures, if any. Here's a slice of that conversation.
Offsetting dynamics here. One is that we look at the underlying economic background. It's one of the strongest global synchronous growth backgrounds we have seen since the 2004 era, where commodities really went sharply to the upside. But the offsetting force to that is this new oil order, meaning the shale revolution is still very much underway, putting downward pressure on long-term oil prices. So while you have upward pressure on the front, you have downward pressure on the long-term price, which is creating a rotation in the oil forward curve, is creating a term structure, what we call backwardation. And that's really where, while we expect oil prices to remain flat to maybe slightly down here, the investment returns we think are going to be significant, really being driven by the shape of that forward curve. Investors go out, buy at a discount, roll up on the front end. So prices potentially flat to down, but upside in returns driven by curve shape.
Right, but how long can that last? And I'm also looking at research, for example, Citigroup saying that wildcards, including war or Middle East tensions, could drive crude to $80 a barrel.
Well, I think the key there is to get up to $80 a barrel, you would have to have that back end of that forward curve become unanchored. And if you think about 1 year out right now is trading around $61 to $62 a barrel on a Brent basis. You look at the cost structure of this industry, it's still in that 50 to 55. That gives significant returns to producers who are going to sell the back end, anchor it, which is why we think the upside from any of these disruptions around the world will be captured in the shape of the curve, not in the price itself.
Okay, is there a sweet spot for OPEC members? If OPEC members see prices rise, for example, Brent above $60, does that not mean that shale producers come back online?
Well, again, it's because it takes time between when the investment occurs and when you get the production. The key is really where the forward price is, not where the spot price is. And I go back, forward prices 1 year out are trading somewhere around 61 to 62, cost basis of 50, 55. That's what they're targeting. If you can keep that back end anchored, that front end can do whatever it wants, because the investment in the shale does not take place on that front end price, but rather on that back end price. Now, in terms of where do they want prices to go, getting too far above 70 starts to create the risk that central banks respond to the inflationary pressures off of higher oil prices. I would tend to think that OPEC members do not want to see that, and that in general we'll probably see more noise and rhetoric if prices trade above $70 a barrel in the coming days to push this market back down to lower levels. But I think the real key here is look at those forward prices. Where are they anchored relative to the price? Because that's the signal for investment, not the spot price.
Jeff Curry, I know you read the price cover to cover decades ago, Daniel Yergin's one-volume must-read on the oil business, and it was about the advent of a cartel. What's the state of the cartel in 2018? And much more importantly, is Saudi Arabia going to drive the bus 5 years from now?
Well, if you look at the shape of the supply curve for oil, before the shale revolution, it was very steep, meaning it was very sharp upward sloping. And if they took supply on and off the market against that supply curve, it would do what? It would make prices go up and down significantly. Today, the oil market is a perfectly competitive market. Remember in Econ 101, you drew the supply curve and it was perfectly flat? Look at the oil supply curve today. Because of the shale revolution, it's very flat. We have your classic Econ 101 competitive market in oil, which makes it very difficult to operate a cartel.
All right, IndusInd numbers on your screen, 936 crore versus 927, slightly higher than expected compared to Bloomberg expectations. But the net interest income number, if I could see it right, was looking a little bit softer than anticipated. Net NPA is more or less in line, no surprise there. The gross NPA number looked a little bit higher. Stock seems to be reacting negatively. I'm not sure to what, but Shraddha standing by. She's giving us the details. Shraddha, over to you.
Ida, I might just repeat the numbers because I don't know what you've said, but I'll just run through the basic number first that I have. Net interest income has grown by about 20%, 1895 crores versus the number versus the number that we were expecting, which was at 1936 crores, so slightly below estimates as far as the net interest income is concerned. Our net profit has come in at 936 crores, broadly in line with what we were expecting, so a growth of 24.7%. That is slightly lower than the 25% growth that we had seen in the second quarter. Gross NPAs for the bank stood at 1.16% as compared to 1.08%. So there has been a marginal increase. It does seem, even if you look at the absolute NPAs, they have come in at around 1,500 crores versus 1,350 crores. So we'll have to see where that marginal hike has come. Having said that, 1.1% still not a bad number. Other income for the quarter on a Q-on-Q basis is steady. Provisions, if you look at them, they have actually come down sequentially. So broadly, from the first look of the numbers, it does seem like they're broadly in line. I'm just trying to go through the notes to accounts, but I believe we also have an analyst with us on the phone line, Ira.
So get a quick reaction while you also keep reading through Shraddha and join in for the conversation. Siddharth Purohit is research analyst at SMC Institutional Equities, joining us on the phone line. Siddharth, first take on the numbers?
Yeah, if you look at the broad numbers, has been almost in line with expectations, whether it is the bottom line number and more so with the asset quality. Gross NPA at 1.16% since almost in line. It has marginally gone up, but I feel that, given the current environment, it's not a point of worry. But a little bit of there is a rise in GNPA to some extent.
On account of Siddharth, I'm not sure whether they were also stuck in that JSPL issue. At least we all assumed it was JSPL. Could it be on account of some one account where the RBI has asked banks to mark it down into NPA, or was there any sort of other risk factor on the asset quality side which is reflecting in the numbers now?
See, it is difficult to say for which particular account it might have gone up or not. But broadly, I can say that, even if there is one or two accounts which might have slipped into NPA, then the overall number is not really very alarming that one should be worried as far as NPA is concerned. So I will leave that, I would take it in a kind of, I would say positive way. It has not really deteriorated too much. And the bottom line number seems fairly comfortable, I would say.
Okay, Siddharth, Shraddha here just wanted to understand, I don't really have the loan growth numbers now, I'm trying to get them, but what is the kind of number that you are working with? Because NI has come slightly lower than the street expectations. It's a marginal number, not really a big miss, but what is the kind of NI and, loan growth and net interest margin numbers that you were working with?
Hello.
Siddharth, if you can hear me, just wanted to understand what is the net interest margin and loan growth numbers that you were working with?
See, we are expecting loan growth of somewhere close to 25%. And I think normally we are seeing that in the last couple of months, we have already seen some amount of pickup in the CV portfolio. So we believe that, loan growth here and more should rather improve a bit in the coming quarters. So, and margins, as far as I believe that, margins will also not be a big point of worry for IndusInd. The reason being a large part of their CV portfolio is fixed. So even if there is a kind of, decline in rate, then normally the margin doesn't take any hit. So margin has never been a concern for IndusInd, I would say. And the loan growth, I believe that, they should be able to maintain the kind of 25-26% growth is what they should be able to maintain going ahead also.
Okay, and just wanted to understand, even with respect to the non-vehicle consumer lending portfolio, I think in the last 3 or 4 quarters we had been seeing that the asset quality in the newer retail segments like tractors, personal loans and credit cards has actually been increasing. Is there something that you're watching out for there?
In fact, I don't have those details as of now, whether there has been any asset quality issues with regards to that unsecured loan portfolio that I need to check. But so far, even if they have grown on those portfolio, the retail portfolio, they have fairly been able to grow. Other than vehicle finance also, they have been growing and without compromising on the asset quality. So all those details I need to really see the press release before commenting on that.
All right, thank you so much for joining us and giving us your time, Siddharth. Neera, just one more update that they have given in the notes to accounts. They've just mentioned that some of the approvals for the merger with Bharat Financial are pending. Anyway, so these are standalone numbers. The Bharat Financial numbers don't come into these numbers. And the last time the management that spoke to us in December, that any which way said that they would take at least another 12 to 15 months for the merger to go through. So just from the first looks of the numbers, the basic numbers that we have, they do seem to be more or less in line with estimates. A slight marginal uptick on the NPA front though.
And no divergence disclosure. I've read through the accounts at least so far, nothing that they have disclosed in the numbers. Thanks, Shraddha.
All right, let's move on now. In a bid to address privacy concern against the Aadhaar program, the UIDAI has now announced 2 new layers of security to the biometric database. Nishant Sharma reports on the new virtual identification number.
As per the circular issued by the Unique Identification Authority of India, a virtual ID now can be used against the original Aadhaar number at the time of authentication for availing various services and welfare scheme. Now, virtual ID is nothing but a temporary revocable 16-digit number mapped to your Aadhaar number. A citizen has to generate its own VID. Once a VID is generated, a token will also be issued, which will be stored by the system to double check the credentials of the VID. Now, a user can generate multiple VIDs, but once you generate a new one, it will cancel out the previous VIDs. You can also set a validity of your VID. Post that, you have to again generate a new VID. Now, UID in its circular also said that it will limit the number of agencies that will have access to your Aadhaar data and biometric IDs. And for that, it has set two categories. One is local and one is global. While the global authentication agencies will be able to access and store your Aadhaar number and data, local agencies can only will be allowed to only store your virtual IDs, and to double check your virtual IDs, they will use the token that was generated at the time of issuing the VID to double check the credentials of the person who was given the VID.
All right, but how does this really impact our lives? We've got Ayush Ailavadi joining us with the details of breaking down how this is actually going to play out.
What is this VID? How does it make your life and my life a little simpler? Well, what we've done at Bloomberg Quint is we've tried to, well, simulate what this might be like, and I'll also take you through what the user experience, the UX, will be like. Well, essentially, we're going to show you what a random generation is. What is a VID? A VID is a 16-digit, well, PIN or code. Why is it different? It's generated for every transaction, right? The first transaction, if you went to any retailer or to an authentication agency, you would essentially just go with your Aadhaar number, a 16-digit number, and you would, well, give that to them, right? Now it changes. What the VID does is that it generates a new one for every transaction. The problem here is that you will actually need to generate this. For example, if this was the UIDAI portal, you will be given this option as a user of Aadhaar. You will have to go either to the Aadhaar UIDAI portal online, or you'll have to go to, well, the M-Aadhaar application, or you can go to the enrollment center where this technology is available. But this will happen over some time. I'll tell you what the timeline is, but this is what a generator is. Have you ever used LastPass as a password generator, or have you used a key generator when you're trying to use some of those virtual drives at home, cracking some of those games? Well, this is similar to what it's like. You will go on it. If this was your Aadhaar number per se, well, this is a fictional number. You hit generate, and what this essentially does is it would generate a new number for that transaction. Let's say that number is X, right? That will work for that particular transaction. When you go out perhaps to, well, get a new SIM, or when you go out perhaps to flash that number for identification, it will work for that particular transaction. You can change it, and the minute you change it, the earlier one is extinct, right? Now, these essentially will be issued starting March 1st. What does this mean? It means that the tools, the application, the infrastructure will be ready by March 1st for everyone to start using, but it doesn't become mandatory. What essentially happens is on June 1st, everyone in the system will be allowed to do this. It never becomes mandatory per se. So you can continue using, well, your UID or your Aadhaar number, which if you were worried about, you still might be concerned about it, right? But this is, well, another layer of security when you're talking about the onion. This is just one layer of security that they've added, and it's a very welcome step. Let's see what people are talking about, right? So you have Mohandas Pai, and he says that we all understand the risk, but there's no greater risk than anywhere else. Even RBI is under the same risk. The UIDAI has responded by saying how it is going to reduce the risk and how it's going to enhance security and protect our privacy. Well, you know, as a proponent of Aadhaar, that seems to be, well, a legit view. But if we move on to what Pranesh Prakash actually told me, he actually said that he requests the UIDAI, and it's a crucial point, to make the virtual ID, which they're coming up with, mandatory rather than optional, and to actually generate VIDs for people to generate these VIDs themselves. It's a welcome start, but a lot more needs to be done. That might be an issue because, well, if you're in a remote village or anywhere where you don't have access to that technology or that bandwidth, you'll actually have to go and do this yourself. Maybe the UIDAI can help us with it. Maybe the enrollment centers will play that part. But remember, it not being mandatory is a big key concern, because at the end of the day, what we are using right now is our Aadhaar number, which is that unique code which is linked to practically everything, right? There are obviously, like Nishant mentioned, there are global and local when they've split it up now, which is interesting because there's global AUAs and local AUAs. They'll be different because the global AUAs will have access to the full eKYC with the Aadhaar number. The local AUAs, which are not categorized as global AUAs by the UIDAI. The UIDAI will decide what is global and what is local. Global AUA status quo, what everyone has access to right now, which is your eKYC data. For other authentication agencies, there will be a new class created called local AUAs. It's not that complicated. It is a step in the right direction when it comes to privacy and security.
Well, that's another layer for Aadhaar for you, but out of time on the show. Thank you so much for joining us today.
Countdown is up next.